Mr. Varun Goenka. He's the managing partner and heads private equity at ValueQuest. Through his presentation, he's going to shed light on the transition from Inflexion to S.C.A.L.E.
So, picking up on what we left and where we are today, the theme of India's metamorphosis from a caterpillar to a butterfly, it reminds me what Darwin said. And the image here is a clear depiction of how evolution is. What Darwin said was that it's not the strongest or not the most intelligent that survive, but the most adaptive to change. Thus, the journey from inflection to scale indeed deserves a thought. So, when we saw part one in the morning of performance of India's going from caterpillar to butterfly, did it really occur to us why does nature really transform a caterpillar to a butterfly? It's because caterpillars have no way of reproducing as they are. Thus, evolution leads them to transform into a butterfly, to continue their cycle of life. So, adapt or die. And not all, mind you, caterpillars would be becoming butterfly. So, inflection is not equal to scale, I must emphasize. All transformations are change, but change is not necessarily transformational. Let me make the difference clear. Change is more outside in, transformation is more inside out. Change more small or incremental, transformation more large and complex. Change is more measurable, more situational. Transformation is an outcome of multiple connecting dots that create megatrends that Ravi spoke about in the morning. Change is more shorter duration versus transformation more deeper and impactful. On a lighter note here, I myself was in a corporate job 2 years back and maybe was leading a caterpillar life. I owe it to Ravi and ValueQuest team for accepting me here, such an energetic and passionate team, to allow me the platform to at least begin that journey from caterpillar to maybe a moth or a smaller butterfly. So is there a pattern to nature's design? As astonishing as it might be, but the golden ratio, the Fibonacci series, actually does explain a large amount of patterns in nature. From the galaxies, to the flowers, to the snails, to the wave formation in the oceans, to even the fingerprint. What's important to recognize is that there is indeed a method to this madness. Similarly, capitalism also has its own patterns of wealth creation that we must seek to discover. So there are 4 patterns that we are about to discuss. Those are unsaid laws of scale and its equations to wealth creation. So pattern 1 is speed. I think the need for speed is inevitable in today's world. So blitz scale or remain subscale. So we live in an era where you either blitz scale or remain subscale. The need for high growth is both a spark for path-breaking innovations and also the lure for investors. Software eating the world, as they say, is ensuring that blitz scaling is indeed possible for thought leaders and people who can execute at scale. And we've seen some companies present today that are walking that path, and we will see a few more companies ahead. Milestones like reaching a few million customers have reduced to a few days from a few decades, as evident from the image up here, where airlines or cars or telephone took a few decades, but a few applications and softwares takes anything a few days to a few months. Our own public digital infrastructure, which was talked about earlier in the earlier sessions, on the right, is itself a proud example of how Aadhaar, UPI, Bheem have scaled to colossal proportions. So let me take an example here. Blitzscaling is an outcome of flywheels created by champion companies. In consumer retail or QSR, for example, the four building blocks are the virtuous cycle of creating industry leadership and large scale. Similarly, platform companies like Amazon, Alibaba have created flywheels within flywheels where building blocks like inventory management, complex logistics management, brand ecosystem, financing have led to high growth for long periods with very high capital efficiency. So to go one level deep is to see why GAFA, which is Google, Apple, Facebook, and Amazon, became as invincible as they are today. They solved for customer problems and filled product gaps at scale, and also deeply entrenched a digital infrastructure around the users with high exit barriers and high frequency of use. But not only did they surround the users, but also integrated vertically into their lives by being a part of their daily life and habits. That is telecom and IT, health, retail, utility needs, entertainment, and of course the entire payment ecosystem. So pattern two, asymmetry. Find winner take all. We are living in a world of winner take all. So let me come to take a step back and why asymmetry. We are taught about the bell curve in academics. However, capitalism is more driven by power laws, which is the law of vital few. Essentially, that means that winners take disproportionate share of market cap or revenues or profits. This is because traditional theory cannot explain practical economic complexity. Academia assumes idealistic and static scenarios, versus the real world is more chaotic and spontaneous. We would see ahead a very glaring example of this asymmetry. So up here we see a graph which is of 61,000 companies over the period from 1990 to 18. That's almost more than 30 years. But as we see, only 800 companies out of 61,000 companies in the study have driven all the wealth creation. More than 60% of the firms have actually destroyed value. That's how asymmetry or asymmetric is wealth creation, and we see that even in our society actually. So corroborating it further with an India example and how is the distribution of size in India, this is the entire universe of companies. There are approximately 4 or 5,000 odd companies listed, but these 640 odd companies actually explain more than 80% of the listed universe. However, out of these 650, if we so these explain pretty much the entire exchange representation, so to say. But if we see by size of the annual cash flow generation, only 117 out of these have been able to reach a 2,000 crores annual cash flow run rate. And incidentally, one of the companies that presented earlier in the day, Vari, would be amongst probably 100 or 50 companies in India to reach that glass scale, the glass barrier. So if one weeds out the low return ratio industries, then even lesser, only 50 companies in India have been able to reach the 2,000 crores. So sometimes when we see high valuation ratios, they somehow price in the management's capability to break these glass barriers and create scale. Pattern 3, which is adapt, and as obvious from earlier examples, we either transform, lag, or die. So very, very simple, and I think we face this in also we call it generation gap in society. So market cycles are not only becoming shorter, but steeper. What used to happen over 100 years is now happening in less than a year, sometimes less than 5 years. And I think the megatrends presentation put enough substance and evidence behind that. So thus, it's important to recognize the core structural changes, if indeed happening within industries. Let me take the example on the left first. The car OEM manufacturers transform from subscale manufacturing to large system integrators. They became assembly lines that are deriving value out of the supply chain ecosystem they've built around them. Similarly, several service functions, which is the image on the right, have moved from being hardware-based to the subscription-based, where you do, and which is called the API revolution, application program interface, which has led to the SaaS economy, or the subscription economy, or the shared economy. Okay, but however, I must emphasize here that the first to market may not always be the dominant leader. The journey has several valleys of death, and winners reveal themselves to keen observers. A high probability and predictability is vital for large absolute wealth creation, and no better example than Berkshire's $30 billion investment in Apple after it became a $1 trillion market cap company. Today, their $35 billion is more than $150 billion. We've heard of the likes of $1 billion trade, the great pound arbitrage, but this is probably the world's first $100 billion trade that Berkshire executed. So the debate of active versus passive will play its course, but indices adapting to change has been evident through decades. Not only companies or industries, but even countries have their cycle of representation on global indices through decades. So if we see the 1980, it was the peak oil era, and thus we had the US companies. And within 10 years, the Japanese companies took over and became the dominant market caps in the world. Thereafter, we had the rise of China, and 2010, we had companies from all over the world as part of the top 10 companies. Eventually, when the tech boom happened, today again, US companies dominate, and hopefully it would be India's time sometime ahead, as has been discussed in the previous presentation. Coming to an Indian example, which is again the same pattern, very, very few companies actually live to tell the tale of being in the index or being amongst the top 30 or 50. There are only 5 companies today, Hindustan Lever, ITC, L&T, Reliance, Tata Steel, which have really stayed in the index for close to 30 years. Several companies like Asian Paints, Bajaj Twins, the Kotak Bank were not even part of the index till 10 years back. So we have to have our eyes, and as they say, you have to have strong opinions loosely held. Another clear evidence of how value shifts from uncompetitive to the competitive. This is a number of companies with revenue of $1 billion. Now, if we see this is for a 20-year period apart, 2003, 2022, we would not see too much of change in UK and Canada. Isn't that the same narrative, that these are the economies where there is hardly any growth? If you see US, okay, from 1,000 odd companies to 15 odd companies, there is some delta. In Japan, there is some delta. But where is the puck? That is China, India, and maybe Taiwan. India has gone from 9 companies to 166 companies today in 20 years. That's the kind of delta. And this is not even absolute revenue. That would be much higher than 15x. These are just number of companies. So the most important value migration, of course, is value creation, moving from physical assets to intangibles. Today, value creation is about customers, talents, ecosystem, social and environmental impact, and software eating the world, of course. Coming to pattern 4, which is growth. Seek rate of change and change of rate. I would like to give credit of this simplification of this slide to Dr. Arvind, who spoke about energy transition in the morning. So essentially, there is the pond and there is the fish. The fish is the company, the pond is the industry. Rate of change, moving from slower to higher growth, is the company size increasing. Change of rate is moving from slower adoption to higher adoption, higher accelerated adoption, which is basically the pond size increasing. We, of course, want a small fish in a large pond that can become a larger fish. So the patterns of rate and change of rate are visible across us. In terms of infrastructure systems, the image on the right, we've seen it across railways, telegraph, etc. We've seen it in individual consumer products, and we keep talk about the consumption J curve. This is exactly what it is. So we had a two-wheeler adoption, then four-wheeler, then you have air conditioners, etc. And this is exactly what the India story is about. So let me summarize the framework. S was speed, W, winner take all, A, adapt, G, the growth pond. So just for simplification's sake, we're calling it swag. These are the 4 building blocks that determine terminal value and change in terminal value. That are the building blocks, the main determinants of ultimate valuation ratios. The statistical valuation ratios do not capture the information around terminal value, which is much lesser understood. A case study of industry selection, I would give credit of this slide to Chirag Lodaya, who is our consumer lead, is that this industry, which we have spent so much of time on, several years on, was at a consumption J curve plus So a lot of factors came together for the whole industry to grow, and we had a company which had the brand, which had the supply chain, which had the product to scale. So we had the pond growing, and we had the fish, which also had the right capabilities. Incidentally, the QSR companies globally have beaten even NASDAQ companies on returns. That's the broad message. So how do we connect top-down to bottom-up? Ultimately, paisa stock picking mein hi banega. VQ's bottom-up investment framework has been in practice for decades, and we would delve there. So we seek to invest in scalable companies with sustainable competitive advantage, adaptive on a long runway with superior execution capabilities, and we'll see some beyond words. We will see some example beyond words. So this is our internal framework of scale that the team works on, and all of us have to adhere to the framework so as to cover our blind sides, so as to be 360-degree well-researched, essentially selecting companies that present compelling business opportunities and eventually viable exits. We will see this framework in a little more second-level depth eventually. So the SCALE framework's rigor pushes us to go a second level into industries and companies. What are the 6 building blocks? It's governance, structure, technology, capabilities, culture, and the partner ecosystem. Now, these are intangibles that would not come to anybody on an annual report or some audit report or some Excel model. One has to get on the ground. One has to do a blend of primary and secondary research, and sometimes actually stand alone on their conviction. So the framework, the SCALE framework, allows us to distill inflection points, because inflection is both positive and negative. So allows us to filter, distill companies that can go from their inflection point to building large scale, and thus the sweet spot of value creation is beyond the mid stage, so to say. It could be a private company, it could be a public company, but what is essential is that the company has gone through its valley of debt, done their bit of experimentation, their cash burn, their organizational maturity, etc., and actually not only builds, see, the profit or the balance sheet or cash flows are outcomes of several intangibles connecting together to deliver those numbers. As Bezos always says, that this quarter was actually built, baked in 3 years back. how do we really harness both the regulatory and the wealth creation advantage that we have? So VQ's Inflexion is that it's embarking on a new journey, the creation of an AIF. The Category 2 AIF is primarily private equity, uh, but it has the best of both worlds, that is public market and private equity. Several global and local uh, wealth creators have built similar playbooks around the world, and we have been studying this for last few years. It's both complementary for us and win-win for investors. Some of the global firms which have actually walked the same path is Sequoia, Bessemer Venture Partners, Tiger Global, to name a few. So what exactly is a source of wealth creation? It is ability to deploy capital, at least the ability to generate returns, and obviously the duration of compounding. And as you saw in the video earlier, compounding is the eighth wonder of the world, primarily because of the time factor. So we have on the x-axis returns, on the y-axis ability to deploy sizable capital. On the top is equity mutual funds, which are struggling to deliver alpha because of their size and scale and because of their ability to wanting to be part of the index, versus our focus is more bottom-up stock picking, and also the late-stage private equity and mid-stage private equity, where we see the sweet spot of returns. Venture capital is not for us because it's a very different playbook altogether. So let me go through a few case studies. Why private equity? And I'm just going to breeze through it, and we would get it. That these are the companies, these are some consumer companies like Vedant Fashion, Devyani, Bekaji, Sapphire, Go Fashion, which actually delivered anywhere between 30–40% CAGR before they actually became public companies. Anywhere between 4 to 7x. So it's important to find these companies a few rounds before the IPO, or maybe a few years before the IPO, to really capture that delta. Similarly, we have some BFSI companies, Policy Bazaar, 5-Star, Avas, which had the same journey like others, 30–40% CAGR before they actually became large public companies. Similarly, franchise companies of Nykaa, Star Health. So let me delve a little bit into Nykaa's case study. Nykaa in September 14 was $17 million valuation, and by the time it became Series D, it was $430 million valuation. And I think at that stage, it was very evident that this is a company that is doing something remarkable, or it is built for scale. And had someone invested even at that stage, it would have been 17x. Now, 400x at seed stage, but 17x from Series D. But the difference is ability to deploy capital. So if you see Series D, had somebody put, let's say, $25 million, it would have been worth, the profit would have been worth $400 million. So our message is the ability to deploy large capital in high growth companies at lower risk results in significant absolute value creation. So the ValueQuest AIF Scale Fund is positioned in a way to be able to invest in mid to late stage companies, private or public, sector agnostic, ability to deploy large capital, 10 to 20 odd companies. We're looking at clear, near, or emerging leaders in their industry with superior execution capabilities, companies at an inflection point. I think we've. So this is an actual case study. So Vari presented in the morning, and we executed Vari Energy's private equity raise last year. And this is an actual case study of what exactly happened. We had the right sizing, high growth, and that can lead to wealth creation. But let me delve into the building blocks of why it is a scalable company. Scalable because it is institutionalized, well-governed, strong second-level management, supply chain, leading technology and vendor partners. Competitive advantage because it is one of the most capital-efficient companies in the industry. Cost leader, deep relationships amongst large global customers. Adaptive because it built a large business without any regulatory support, adapted through industry technology and supply chain shifts, It is backward integrating into its value chain, which would further enhance its competitive advantage. Long runway, multiple growth drivers, export opportunity driven by China Plus One, India's energy and sustainability ambitions, favorable global and India regulations. Finally, superior execution. In the last 10 years, it has gone from 300 crores revenue to 6,500 crores odd revenue. The profit has gone from 25 odd crores to 400 crores odd, and FY23 order book today is $5 billion, as Hitesh Bhai already showed. And this is just an illustration. We have several companies that have presented during the conference which have a similar playbook. Even going ahead in the next few minutes, you will see a few companies. So building amongst the largest and most capital efficient companies, whether it be manufacturing, whether it be within the financial sector, whether it be within the consumer sector, that's our bottom line. Finally, I think these guys are rocking. This is all over the world, making India proud. But what's our message? Return on capital, rate of change, and change of rate equal to change of our fate. So to rise, roll, revolt in wealth creation, I think this is the. Thank you so much.